Welcome back to Best Prop for You. US crude oil is actually seen quite of an upside today, jumping more than 9% in the recent sessions to top, $80 per barrel. The primary driver, of course, the collapse of the US-Iran truce. The Middle East conflict has escalated into an open battle now for control of the Strait of Hormuz once again. Iran launched attacks on two UAE tankers, completely disrupting the world's most critical energy corridor. In response, of course, President Trump reinstated the blockades on Iranian oil exports and ordered heavy military strikes on over 100 Iranian installations. So with the years now preparing again for a prolonged battle and Washington pushing for tougher sanctions on Russian energy exports, there is, of course, these geopolitical risk premiums that are being priced back into the prices of oil. To make matters worse for the broader economy, the Federal Reserve Governor Christopher Waller delivered a quite hawkish speech. He warned that if this week's core inflation reading comes in hot, which is highly likely given the surge in energy prices, the Fed may need to implement stricter policy and resume rate hikes. So let's jump into the charts to see how this translates. Well, starting on the daily chart, as always, oil did not fall below the 67 support level that we have highlighted last time around. It found a hard floor actually here and has since bounced. And this bounce seems important, given that we have crossed above the middle Bollinger Band and the outer bands in both cases, both lower and upper, are starting to tilt inward toward the center. This is telling us actually that there is a likely period of a longer term consolidation, and the since we have bounced off the bottom, we could potentially rise as high as 90 if we manage to get through 86. They're just structural support levels and the Bollinger Band resistance. So if this bullish momentum holds, our next major target is 86. And then we have ultimately the 90, which aligns, of course, with the upper Bollinger Band. There is something important to mention here. We have seen a slight momentum divergence on the RSI, and currently the RSI is just at 55. So imagine if we were to reach overbought territory, that gives a lot of space to move further higher up, right? Now, of course, on the downside, our safety nets are the median line at 76, very near short-term actually level that we need to take into account. Without that meaning we're going to revert, but we do have the let's say the gap fill at 72. That is a bit more of an important level, because if we do lose that in terms of in case we turn short-term bearish, then we'll probably look into revisit the 67 level once again if we do break below the 70 handle, since it is a supportive level, of course. Let's go down on the 4 hour to see, however, what exactly that specific time frame is telling us. Things here are looking a little bit different, right? We have two scenarios that I'm looking, and so far we have to consider the first one as the first option, because we don't see a corrective structure. We see an impulsive structure, and this would be this being actually a 5 wave left to the upside. That means that is a reversal point for the longer term, and we have a 1, 2, and we're currently are still doing the third wave, then we get fourth wave and then fifth wave. Why though? Because, well, typically waves 1 and 2, when we use the Fibonacci extension, get us to the 161.8 Fibonacci extension, and this is actually at 85. Critically, importantly, this is the golden extension at Fibonacci, right? And it sits exactly where we have structural resistance, or we could say support that didn't yet turn resistance. So this level is important, and if we do maintain the 79 level, we could actually reach that in the short term, regardless of whether this is a 3 or a 5 wave move. Okay. So the second scenario is that one that adds a little bit of cautiousness. Now we stopped at the 100%, which is at 80, not just a psychological heart, but also a Fibonacci extension level, the measured move, pretty much, including the pullback. What this suggests is that we might be actually dealing with an ABC correction, which is a 3-wave move. Okay, and if we are dealing with a correction, which is a 3-wave move, that means that 80 is going to be a hard resistance. So if we fail here, but hold above let's say 76, okay, this still remains impulsive. if we fail here and we lose 76 as well, then the wave 1 or wave A, actually this becomes a 3-wave move, okay, which is just a simple correction, and then we will likely drop back to the wave 2 support around 70, and then perhaps down to 67 once again. But as always, you know, we need to go on the 1 hour too. But before I go to the 1 hour, now that I'm seeing the RSI, let's not forget, this is why we have to be cautious at 80, because we don't typically see divergences like that appearing in a wave 3. So it is a high likelihood that we have a 3-wave move rather than a 5 on the one hand, but that doesn't make it more likely to reverse. What makes it more likely a correction is when we break below the 76 level. So that might be a confirmation. So on the 1 hour, what we do see actually that both peaks, the RSI momentum was about the same level. Okay. And this is important for context. We have similar momentum across the two peaks, which makes them equally, again, leans towards the ABC rather than the 1, 2, 3, 4, 5 scenario. So if this isn't an impulse, it's a correction that might have just ended at the 80 level. So what, however, is also adds a little bit of uncertainty again is the fact that from a channel perspective, we are considered to be in an impulsive continuation currently, because we not just trade above a 79 and the middle 1 hour band, but also outside the channel. And as long as we're outside this channel, the bias remains upwards. So if we lose 79 and cross below the median line in the Bollinger Band, and we actually re-enter this channel without going for a new high, of course, then this more likely is going to be that a correction might have just ended at the 80 equality level. So we have, of course, drawn this channel. You can also connect, if you connect these 2 points and the peak, to assess in a similar way that I'm doing here on my charts. So losing the 78 likely sends us down to test the 76 level, which is the previous peak over here that we've talked. It's the decision maker on whether this is an impulse or a correction, and breaking that opens the trap door to lower territory. So watch the 80 ceiling and the 78 floor to dictate your next move. Trade safe and keep an eye on the Strait of Hormuz deadlines.